Look, every generation of investors thinks they're the smart ones. Every cycle, people look at the charts, look at the tech, look at the profits and say the four magic words, "This time is different." Sir John Templeton, the guy who compounded at around 15% a year for almost 4 decades, called those the four most expensive words in the English language. And he wasn't being dramatic. Nothing drains a brokerage account faster than plain old greed dressed up as, "I'm just a visionary." And he wasn't alone. Jesse Livermore, one of the OG speculators back in the early 1900s, put it even more bluntly, "There is nothing new in Wall Street. Whatever happens in the stock market today has happened before and will happen again." So here's the uncomfortable question. If nothing on Wall Street is really new, what past chapter are we accidentally replaying right now? Most people, when they think bubble, jump straight to the dot-com mania or the 2008 housing crash. But there's another bubble that almost nobody talks about anymore, and it looks disturbingly similar to what's happening with today's megacap tech stocks. To see it, we've got to rewind to the late 1960s. Post-World War II America was on a 20-year sugar high. Factories were humming, the interstate highway system was spreading across the country, suburbs were exploding out of the ground, and US GDP was compounding like crazy. If you were an average American back then, the story felt simple. Wages were rising, jobs were plentiful, the US had just beaten the Nazis, landed on the moon, and invented more consumer gadgets than you could keep track of. Confidence wasn't just high. It was baked into the culture. The idea that America could actually struggle economically felt almost laughable. And right in the middle of this optimism sat the stock market. From the end of World War II in 1945 to around 1970, the major U.S. stock indices climbed more than 350%. That's the kind of run that convinces people the market is less of a risk machine and more of an ATM. Out of that backdrop came a brand new religion on Wall Street. Investors started talking about something called one-decision stocks. The idea was seductively simple. Find companies so dominant, so bulletproof, that you only ever had to make one decision about them. But once. And never sell. These weren't sketchy penny stocks or tiny tech names you've never heard of. They were the bluest of blue chips. Coca Cola, McDonald, American, Express, Xerox, Polaroid. Household brands with real products, real profits, and global reach. These companies made money in good times and bad. They had moats. They had growth. They had story. Wall Street gave them a nickname, the Nifty 50. If you bought the Nifty 50, the story went, you didn't need to worry about market timing, recessions, politics, none of it. You just bought these forever names and went golfing. And that's exactly where the trouble started. Here's the thing about any investment that's sold as a no-brainer. If it sounds risk-free, the risk is just hiding in the price. By the early 1970s, the Nifty 50 weren't just expensive. They were priced as if the basic laws of financial gravity had been repealed. To put numbers on it, the overall U.S. market at the time traded around 15 times earnings. Not cheap, not crazy, just normal. The Nifty 50, on the other hand, were in a different universe. Rough examples from that era. Coca Cola at roughly 40, 50x earnings, Xerox close to 50s, McDonald's pushing toward 80x, Polaroid around 90x. On average, the Nifty Group traded at about 40+ times their annual profits, nearly 3 times the broader market. And it wasn't just valuation. It was concentration. At their peak, the top handful of Nifty names made up about a quarter of the entire market. The full Nifty 50 controlled close to 45% of U.S. equity market value. If you owned an index fund, which was starting to become a thing, you weren't just buying the market. You were making a giant bet that these superstar companies would grow fast enough to justify those nosebleed prices. Sound familiar yet? Then the world changed. Between 1973 and 1974, a series of macro dominoes started falling. The OPEC oil embargo sent oil prices to the moon, roughly quadrupling in a short span. Inflation in the U.S. blew past 10%, peaking around 11%. Unemployment roughly doubled, from the mid-4% range to around 9%. President Nixon had already effectively taken the dollar off the gold standard, ending the Bretton Woods system and shaking global confidence in currencies. It was like the perfect storm of, oh no, for an overly confident market. The result? The major U.S. indices dropped roughly 50% from 1973 to 1974, the worst bear market since the Great Depression at that point. And those one-decision wonder stocks? They didn't just correct, they cratered. Coca Cola fell on the order of 60%, McDonald's lost more than 70%, Polaroid plunged by over 90%. Investors who believed they were buying can't-miss compounding machines found themselves stuck in names that went nowhere for years. And that's the part people forget. This wasn't a quick V-shaped rebound like 2020. It took the broad US market roughly 8 years, until the early 1980s, to fully claw back to its old highs. For almost a decade, a generation of investors got a masterclass in what happens when great businesses meet ridiculous prices. Fast forward to today. We're not in the 1970s. The economy is different. Technology is wildly more advanced. We've got AI, cloud computing, smartphones, and a Federal Reserve with a bigger balance sheet than some countries. But as Mark Twain supposedly said, history doesn't repeat itself, but it often rhymes. And the rhyme today has a name, the Magnificent Seven. You know the cast. Apple, Microsoft, Alphabet, Google, Amazon, Meta, Tesla, Nvidia. These 7 companies now account for roughly a third or more of the S&P 500's total value, depending on the exact day you check. In some measures, it creeps toward the mid-30% range. 7 tickers carrying the weight of hundreds of others. Sound a lot like a modern version of one-decision stocks. Because that's exactly how many investors treat them. You don't trade these, you just own them. They're the future of everything. You'll regret selling. Again, phenomenal businesses. No argument there. These are some of the most profitable, innovative companies on earth. But remember the Nifty 50, great companies plus unrealistic prices was the problem, not the quality of the businesses. So where are we on price today? Rough ballpark P/E ratios as of recent data. Alphabet and Meta in the high 20s, Amazon in the 30s, Apple upper 30s, Microsoft also upper 30s, Nvidia around 50x earnings, Tesla. Well, depending on the quarter, well into the hundreds on a P/E basis. Not dot-com bubble levels across the board, but definitely priced for perfection. At the same time, the Fed's been cranking interest rates to the highest levels in over 20 years and growth is slowing. Investors aren't just saying, these are good companies. They're saying, once again, these are the only companies that matter. So what's actually dangerous here? It's not that Apple is going out of business or that Nvidia suddenly forgets how to design chips. The real risk is a market structure where a small number of superstar companies dominate the indices. Their valuations assume years of flawless execution. Any disappointment in growth, regulation, or macro conditions hits not just these names, but everyone holding the market. Back in the 1970s, people told themselves, Coke, McDonald's, Xerox, these brands are everywhere, they'll grow forever. Today the story is Apple, Microsoft, Nvidia, they are the economy. AI, cloud, search, social, how can they lose? Different logos, same psychology. And just like the Nifty 50 era, all it might take is a few macro shocks, stubborn inflation, higher for longer interest rates, a policy mistake, an AI spending slowdown, for those perfect earnings stories to get repriced very, very quickly. Warren Buffett has a line I think about a lot. What we learn from history is that people don't learn from history. So where does that leave us? There are really 2 broad possibilities. Scenario A. This is another Nifty-style setup. The Magnificent Seven stay amazing businesses, but the gap between price and reality closes the hard way. Maybe it's a recession, maybe it's an earnings slowdown, maybe it's regulation. The cause almost doesn't matter. What matters is that the multiples compress, the concentration unwinds, and index investors live through a rough, possibly multi-year hangover. Scenario B. They actually grow into the hype. The bulls will tell you. AI is a new industrial revolution. These platforms are natural monopolies. Profit margins will stay fat for a decade. If that plays out perfectly, today's valuations might not look insane in hindsight. But understand what that means. To just earn a reasonable return, these companies have to keep executing at a very high level, in a world with higher rates, more competition, and regulators watching their every move. Either way, the risk is the same. When one small group of stocks becomes can't miss, history says they usually can miss, and when they do, a lot of people get hurt at the same time. So, are we guaranteed to relive the 1970s Nifty 50 crash? No. Markets almost never copy-paste. But the pattern, overconfidence in a tiny group of market darlings, priced as if nothing can go wrong, that pattern shows up again and again. Right now, a lot of investors are staring at their portfolios, seeing those mega-cap names carry everything, and quietly whispering, "Relax. This time is different." Those are still the most expensive words on Wall Street. So I'm curious where you land on this. Do you think the Magnificent Seven are a once-in-a-lifetime group that will actually grow into these valuations? Or are we watching a modern remake of the Nifty 50 bubble, just with better graphics and some AI branding sprinkled on top? Drop your take in the comments. I'll be reading them. And if you want more animated deep dives into how markets actually work, not just the marketing version, make sure you're subscribed to FinanceToon Studio.